The S&P 500 is like a giant scoreboard for the US economy. It tracks the performance of 500 of the largest companies in America. These companies represent a wide range of industries from technology to healthcare to energy. When the S&P 500 goes up, it generally means that investors are optimistic about the economy. Conversely, when it goes down, it suggests growing concern about the future. Investors are constantly deciding which companies they think will be the most successful. They buy and sell stocks based on these beliefs. The S&P 500 reflects these decisions. Its movements can influence everything from interest rates to consumer spending. Understanding the S&P 500 is essential for anyone who wants to make sense of the financial world. In recent weeks, the S&P 500 has been on a roller coaster ride. After reaching record highs earlier this year, the index experienced a sharp decline. This sell-off was triggered by growing fears of a recession. Several factors have contributed to these recessionary concerns. Inflation, which has been stubbornly high, is eroding consumer purchasing power. The Federal Reserve has been aggressively raising interest rates to combat inflation. Adding to the uncertainty is the ongoing war in Ukraine, which has disrupted global supply chains and fueled energy price volatility. As a result, the S&P 500 and other major stock market indices have fallen sharply from their recent highs. Despite the recent market turmoil, there have been some glimmers of hope. S&P 500 futures, which are contracts to buy or sell the index at a future date, have shown signs of bouncing back. This suggests that some investors believe the sell-off may have been overdone and that the market may be poised for a rebound. Several factors could be contributing to this renewed optimism. The US economy remains relatively strong, the unemployment rate is near historic lows, and consumer spending, while slowing, is still holding up. Some investors may be seeing the recent market dip as a buying opportunity. They may be scooping up stocks at discounted prices, betting that the market will eventually recover. The recent volatility in the S&P 500 highlights the dynamic nature of financial markets. Investor sentiment can shift quickly based on a wide range of factors, including economic data, geopolitical events, and even rumors and speculation. One key takeaway from the recent market sell-off is that investors are clearly concerned about the risk of a recession. The combination of high inflation, rising interest rates, and slowing economic growth has created a sense of unease among market participants. This uncertainty is reflected in the increased volatility we've seen in the S&P 500 and other asset classes. High-frequency trading algorithms can exacerbate market swings by rapidly buying or selling assets based on pre-programmed rules. In times of uncertainty, it's essential for investors to stay informed, avoid emotional decision-making, and focus on their long-term investment goals. The Federal Reserve plays a crucial role in the US economy and, by extension, the performance of the S&P 500. As the central bank, the Fed is responsible for controlling inflation and promoting maximum employment. One of its primary tools for achieving these goals is setting interest rates. When the Fed raises interest rates, it becomes more expensive for businesses and consumers to borrow money. This can slow down economic growth, which can negatively impact corporate profits and, in turn, stock prices. Conversely, when the Fed lowers interest rates, it becomes cheaper to borrow, potentially stimulating economic activity and boosting the stock market. Currently, the Fed is facing a delicate balancing act. Inflation remains stubbornly high, prompting the central bank to raise interest rates aggressively. The market hangs on every word from the Fed, closely watching its statements and policy decisions. Consumer spending accounts for roughly 70% of the US economy, making it a critical driver of economic growth. When consumers feel confident about the future, they tend to spend more, boosting businesses and supporting economic expansion. Conversely, when consumer confidence wanes, people tend to tighten their belts, which can slow economic activity. Several factors can influence consumer confidence, including job security, income growth, inflation, and overall economic outlook. When unemployment is low, wages are rising, and inflation is under control, consumers tend to feel more secure and optimistic about their financial futures. However, when inflation is high, as it is now, it erodes consumer purchasing power, making people feel less financially secure. The recent market volatility and recession fears can further erode consumer confidence. This can create a negative feedback loop where declining consumer confidence further slows the economy, potentially leading to a self-fulfilling prophecy of a recession. While the recent market volatility might feel unsettling, it's essential to remember that market cycles are a natural part of investing. These cycles have been observed for decades, and understanding them can provide valuable insights for investors. The stock market doesn't move in a straight line. It experiences periods of growth and decline, often influenced by economic cycles, geopolitical events, and investor sentiment. Recognizing these patterns can help investors make more informed decisions. Over the long term, the U.S. stock market has historically trended upwards. This upward trajectory is a testament to the resilience and growth potential of the market. Despite numerous recessions, market crashes, and periods of uncertainty, the S&P 500 has delivered positive returns over the long run. These events, while challenging, have been followed by recoveries and new highs. This historical performance provides a degree of comfort for long-term investors, suggesting that even if the market experiences a downturn, it's likely to recover eventually. Staying invested through the ups and downs can be rewarding. However, it's crucial to remember that past performance is not necessarily indicative of future results. Each market cycle is unique and future returns can vary. Understanding historical market cycles and trends can help investors maintain a long-term perspective and avoid making rash decisions based on short-term market fluctuations. Knowledge of these cycles can be a powerful tool in an investor's arsenal. Investing is a marathon, not a sprint, and patience and discipline are often rewarded in the long run. By staying the course and keeping a long-term view, investors can navigate the market's ups and downs more effectively. Navigating uncertain market conditions can be challenging for investors. The financial landscape is constantly shifting, and staying informed is crucial. With recession fears looming and the S&P 500 experiencing volatility, it's crucial to have a sound investment strategy and a well-diversified portfolio. This helps in mitigating risks and ensuring long-term growth. Here are some key considerations for investing in uncertain times. These strategies can help you navigate through market turbulence with more confidence. First, review your risk tolerance. Understanding how much risk you can handle is fundamental to making informed investment decisions. Market downturns can be nerve-wracking, and it's essential to ensure your portfolio aligns with your risk tolerance. This alignment can prevent panic-driven decisions. If you're losing sleep over market fluctuations, it might be a sign that your portfolio is too aggressive for your comfort level. Adjusting your investments can bring peace of mind. Consider rebalancing your portfolio to reduce your exposure to volatile asset classes like stocks. Second, diversify your investments. Diversification spreads risk across various assets. Diversification is key to managing risk. By spreading your investments, you can protect your portfolio from significant losses. Don't put all your eggs in one basket. This age-old advice is particularly relevant in volatile markets. Instead, spread your investments across different asset classes such as stocks, bonds, real estate, and commodities. This approach can provide a buffer against market swings. This can help cushion your portfolio from losses in any single asset class. Third, consider dollar-cost averaging. This strategy can be particularly effective in volatile markets. Dollar-cost averaging involves investing a fixed amount of money at regular intervals, regardless of market conditions. This method can smooth out the highs and lows of the market. This strategy can help reduce the impact of market volatility on your portfolio and potentially lower your average cost per share over time. Consistency is key. Fourth, focus on the long term. Keeping a long-term perspective can help you stay calm during market fluctuations. Don't panic sell based on short-term market fluctuations. Staying the course can lead to better outcomes over time. Predicting the future of the stock market is notoriously difficult. The market is influenced by a myriad of factors, many of which are unpredictable and can change rapidly. However, by analyzing current economic data, market sentiment, and potential risks and opportunities, we can make some educated guesses about what might be in store for the S&P 500 in the coming months and years. This involves looking at trends, historical data, and expert opinions to form a comprehensive view. In the near term, the S&P 500 is likely to remain volatile as investors grapple with recession fears, inflation, and the Fed's monetary policy decisions. These factors create a complex environment where market sentiment can shift quickly. Despite the current uncertainty, the long-term growth potential of the U.S. economy remains intact. Historical data shows that the market has always rebounded from downturns, driven by innovation and economic resilience. Corporate earnings are generally strong, and innovation continues to drive growth in key sectors like technology, healthcare, and renewable energy. These sectors are expected to be the pillars of future economic expansion. Several potential risks could derail the market's upward trajectory, including a deeper-than-expected recession, persistently high inflation, geopolitical instability, or a major policy error by the Fed. Investors need to be aware of these risks and plan accordingly. The S&P 500's recent volatility is a reminder that market cycles are a natural part of investing. Understanding these cycles can help investors make more informed decisions. By staying informed, managing risk, and focusing on their long-term goals, investors can navigate periods of uncertainty and potentially achieve their financial aspirations. It's about balancing short-term challenges with long-term opportunities.